My name is Jake, welcome to the channel. In today's video, I want to talk with you all how to know if a dividend ETF is good or bad. The number one question that I get on my channel these last 5 years has been, is this a good stock or ETF? And by telling you if it's a good or a bad stock or ETF, it doesn't really help you because you become dependent on my or someone else's opinion. So in today's video, instead of giving you a fish once and telling you my opinion on one single stock, I'm going to teach you how to fish and how to actually look at an ETF and to decide for yourself if it's a good or bad ETF. And if you're new to the channel, once again, my name is Jake. I retired from my 9-to-5 job last year at the age of 37. I reached what is called barista fire. I make YouTube videos on the side. Something that I've learned over the years is that investing is personal and that there are many paths that can lead to success. I also have learned that there's some fundamental things that every investor should be aware of. I wouldn't necessarily say there's a right or wrong way to investing because everybody's goals are different. But I would say that there is good and better when it comes to investing. And this can range from, the most obvious things like the expense ratio of an ETF or how the fund's distributions will be taxed. Investing can bring its own unique opportunities and challenges. And when we look at other areas of our lives, there's generally a right and wrong way to do most things in life. And it could look a little like this.
2, 1, here we go.
Oh man, I'm just going to leave that there and just casually move on. So in this video, I jotted down some notes and some things that I wanted to share with you in this video. The way that I'm looking at this is if you and I were sitting down in the same room, and if you were to ask me, hey Jake, how do you look at dividend ETFs? How do you know if they're good or bad? I'm going to walk you through my process of how I consider if an ETF is good or bad. But I do want to say that investing is subjective. Everyone has different goals and strategies and things that they're trying to do. And so I want to keep that in mind. So really when looking at this, there's two main things to understand when you're looking at an ETF, to understand if it's a good or a bad ETF to invest in. And the first thing is deciding if it's a good or bad ETF based on a certain criteria, a certain criteria that we're going to touch on here. And then the second is understanding the different types of ETFs available. And I want to say a quick thank you to Seeking Alpha for sponsoring this video. I'll talk more about Seeking Alpha Premium at the end of this video. All right, so this first section of this video, we're going to touch on the 7 things to understand when deciding if an ETF is good or bad. And so the very first thing that you want to understand is the fund methodology. Okay, the fund methodology is how the companies in the ETF are screened. For example, you look at SHD. SHD is a high quality dividend ETF, but the way that the fund methodology works is it doesn't look at 10 consecutive years of dividend growth, but rather it looks at companies and includes companies that have 10 years of paying a dividend. That is fundamentally different than a company that has raised it for 10 years. Okay, do you understand that? I bet a lot of you didn't actually know that it's not 10 consecutive years, but rather that it's just 10 years of paying a dividend. And that's why you're going to have some companies in here that may have cut their dividends in the past or in the last couple of years, but they're still included in the index. But that's how this index works for SHD. So, if you want an index that looks at 10 consecutive years, well, you're going to want to look at VIG. VIG screens companies based off of, 10 years at least of consecutive dividend increases. So the very first thing when I get asked the question, hey, Jake, is this a good ETF? I first look at the fund methodology. Now, whether the fund methodology is good or bad can be subjective. In my opinion, I try to look and see and understand, well, what's important to me? I'm more of a conservative growth investor, dividend growth investor. I don't really like to speculate. I don't like unnecessary volatility. And so for me, I always look at, well, if I'm going to retire, is this, retire off my portfolio, is this index going to support a stress-free retirement? And does the methodology support that? Okay, so that's the very first thing. And you might be thinking, well, Jake, what is a fund methodology? If you go over to Seeking Alpha or any other website, what you're going to want to do is you're going to want to do a little bit of digging, okay? And if you go down here and you go into the fund profile, you're going to be able to read and see, okay, how the fund is set up. But what you're looking for is the fund index or the methodology. And in the case of SCHD, SCHD tracks this index right here, the Dow Jones US Dividend 100 Index. The second thing that you want to look at is you want to understand, is the ETF actively managed or is it a passive index fund? Okay, actively managed means in most cases, in almost every case, you're going to have a higher expense ratio. So you're going to be paying higher fees, management fees, administrative fees to the fund manager, right? Because they are actively managing it. They're actively trading in and out of stocks based off of, set guidelines that they have in their fund. Or if it's a passive index fund, all it does is it tracks the rules of an index. And whatever the rules indicate or dictate, that is what the fund is going to do. There's nobody in the background deciding whether or not they're going to do one, include one stock or another. It's all rule-based. So that's really, really important. And I tend to skew more towards passive, like almost 99% of the time. The only active funds that I ever consider are covered call ETFs. Those are the only funds that I personally consider. Some people like closed-ended funds. That's great. You can go that route as well. Just understand the difference between an actively managed fund and a passive fund. The third thing to understand is to understand how the fund is set up. What is it tracking, right? Is it a thematic ETF? Is it a sector ETF? Or is it a sector neutral ETF? In certain cases, you can have an ETF, an index fund, that tracks a specific theme. For example, EVs, electric vehicles, or you could have one that tracks semiconductors. You can have one that tracks dog food, right? Animal products. Everything under the sun, there's a thematic ETF out there, okay? So that's the first thing. And I generally do not like thematic ETFs because in most cases, they have high fees. A lot of them are actively managed, and I'm just not the biggest fan of thematic ones. Another one here is sector ETFs. Sector ETFs are different. They're kind of similar, but different. Sector ETFs, you're just simply investing into an ETF that tracks a single sector. One of my favorite is, for example, VGT, the Vanguard Information Technology ETF. As you can see here, technology is represented by 99% of this fund. You're going to get a massive amount of technology. And so if you specifically want to skew your portfolio more towards technology, this is a great option. For example, in my Roth IRA, I have a good amount of VGT. Now, for example, if you wanted more of a dividend focused ETF or one that has a higher yield, you could look at one, for example, like a utility ETF. So this is a sector ETF. Now, the other one, the last one that I mentioned, was sector neutral. Now, most ETFs, unless they specifically say thematic or sector specific, most of them are going to be sector neutral. Okay, and so that means you're going to get a basket of everything. You're going to get a little bit of everything. And another thing that I would kind of bucket into this is your small, mid, and large cap, right? You can have a small cap fund, you can have a mid cap, a large cap. Now, the fourth thing here is probably one of the most important, and that is the expense ratio. What are the fees that you're going to be paying by owning, this ETF or this actively managed fund? Now, this is especially important with your 401k. Your 401k through your company, a lot of company 401k plans don't have a lot of good options. And so filtering by the expense ratio is always, in my opinion, a good place to start. The question that you want to ask yourself is is this expense ratio justified? And then after you've asked yourself that question, is this justified? I want you to use an expense ratio calculator. And if you do that, for example, 1, 2, 3, I'm going to show you if you were to retire at 50 years old. Let's say you retired at 50 years old. If you just invested in the S&P 500, right, you're going to pay over the course of those 30 years just under $55,000. Earnings, or your ending value net of fees, is going to be this, just 6.6 million. Now, if you invested, $500,000 into SHD, well, it's going to double, right? Okay. Now, if you invested into an ETF that has a high management fee, a high expense fee, and I've talked about a few of these on my channel, a lot of people don't like when I'm critical of some of these covered call ETFs, but the math doesn't lie. Okay, if you use the same assumptions, let's assume that you invest into an actively managed fund, whether it's covered call or not, you have to understand that fees are real. Okay, look what it does to your total return after fees after 30 years. Look at that. Your net value went down almost $2 million almost, just by having it be 1%. And that is why it is so important that you don't invest into ETFs that charge outrageously high expense ratios. Okay, got it? Good. The fifth thing that you want to understand is taxes. How is your distribution or how is your dividend going to be taxed? Now, this is really important, guys. It's not the most sexy topics to be talking about here on YouTube. I know a lot of you are in your 20s and you have better things on your mind than thinking about Uncle Sam, but taxes can have a huge drag on your total returns over a long period of time. And as you make more money, as you get more dividends, it's going to become a bigger deal. So you want to understand the basics. You want to understand, is this ETF qualified versus non-qualified? A quick way that you can do this is if it's a domestic ETF that just holds US-based companies, right? The easiest way that you can do this in a half a second, go on Seeking Alpha, go into the holdings and look and see if you can see any bonds, treasuries, or real estate. In the case of SHD, you will see that there is zero real estate. Now, this comes back to the fund methodology. The fund methodology excludes real estate from this index, okay? So this ETF is 100% qualified. Now, if you go, let me just give you a quick example here. This is a pretty popular ETF. I'm neutral on this ETF. The performance has been kind of lackluster, but what do you notice here? With this ETF, SPYD, you'll notice that real estate represents 24%. So what you have to understand is at tax time, a quarter of your yield, your distribution or your dividend is going to be classified as non-qualified. And it's not going to be the end of the world. It'll just be classified on your 1099 dividend form. It'll be separated. It's easy at tax time. You just take your form and upload it in TurboTax. You give it to your CPA. It's not the end of the world, but you have to understand, if you're in a high tax bracket, this is going to be a higher drag. If there's no real estate, there's no bonds, like for example, BND, this is how you'll know this is 100%. Don't quote me on the 100%, but overwhelming majority, near 100, non-qualified because it's a bond, right? It's a bond ETF, and this is the opposite of a qualified dividend. Okay, so if it has real estate or bonds, that will be taxed at the non-qualified rate or your regular W-2 rate, and if it has no real estate, no bonds, it will be classified as qualified and it will be taxed much more favorably. Understand, if you invest into covered call ETFs, read up on return of capital. And when it comes to return of capital, I generally look at it as bad because return of capital, in my eyes, is usually guilty until proven innocent. So, because return of capital can be destructive return of capital. And so it's just so important that you understand these pieces. And when you look at a covered call ETF, that you don't just look at the distribution, but you look under the hood and truly understand what you're getting. The sixth thing to consider is international versus domestic, understanding which countries are included in the fund. And you can find this a lot of times in the fund methodology. Some ETFs will exclude international and some will just include emerging markets and some of them will just include North America. So just understand that, what you're investing in, and you can do this by looking at the fund's methodology, or you can use websites to check and see what is the country breakup. For that, I generally like ETF.com. That usually works pretty well when looking at the country breakup. The seventh thing to consider is the turnover rate. How often are companies being replaced in and out of the fund? And each of the fund is going to have a different way of how they set that up. And it's just important to understand that the higher the turnover rate, which you can see here under risks on Seeking Alpha, the higher the turnover rate, it just means that the fund is bringing in and out companies at a faster rate. And so generally you don't want to see a high percentage. 28 is on the higher end. This is SCHD, right? SCHD has a 28% turnover rate, and that's pretty high. So just understand that, the higher the turnover rate, the higher the risk that the fund has, because that just means that it's changing on a regular basis. So now that we understand the 7 criteria when evaluating different ETFs, if they're good or bad, now let's take a look at 6 different buckets of ETFs. Now, I've summarized this into 6. There may be more, but when I think about ETFs, this is generally how I bucket or classify ETFs. The first bucket is going to be just very generic growth ETFs. Growth ETFs with a single focus of investing into this ETF for the purpose of it appreciating in value. The second would be dividend growth ETFs. ETFs that hold companies in them with a specific goal and with a specific filter based off of dividend growth metrics. The third bucket is ultra high dividend covered call ETFs. Now, this is just kind of lump summing them all together. This is your covered call ETFs. This is your JEPI. This is your JEPQ, your QYLDs. This is where you would find your ultra high dividend covered call ETFs. The fifth bucket is going to be your bond ETFs, and then the sixth bucket is going to be your commodity ETFs. Next, what I want to do is I want to give you a brief example of the first 4 buckets of an ETF that I like and an ETF that I don't like as much. So the first one that we're going to take a look at is growth ETFs. The first growth ETF that I really like is the Schwab US Large Cap Growth ETF, ticker SCHG. And the thing that I like about this, first thing that stands out is the very low expense ratio. The expense ratio is very low. The next thing that I like is it has an overweight in technology, but it's not overly skewed. It's not like 80 or 90%. So you're still getting other sectors in this ETF. The largest holdings are going to be Apple, Nvidia, Microsoft. The one thing that you do want to understand is you're very overweight in the top 10 holdings. But, I much prefer to have an ETF like this than to have, the single stock risk of investing just into one of these, right? Imagine you just had 12% into Apple, and let's say in a couple of years, Apple were to go down in value. The great thing about this ETF is as Apple goes down, or if Apple were to go down in value, it would be represented less and less quarter over quarter in this ETF. Okay, and so you wouldn't have to actively manage that. It's already managed for you in this ETF. And I love that quote from J.L. Collins from his book, The Simple Path to Wealth. It's really, truly the survival of the fittest. That's how I look at these market cap weighted ETFs. Now, an example of a growth ETF that I do not like, and that is the ARK Innovation, the ARKK. And the reason is I do not like the high expense ratio. The expense ratio is astronomically higher than SCHG, for example. The holdings in here it's a actively managed fund, right? And for me, I much prefer passive index funds. And this is an actively managed fund. And, the fund methodology is very unique. I'm not saying to go out and sell this ETF. I'm just saying from, an apples to apples perspective of a growth ETF, I much prefer the other one here in SCHG. Now, if you wanted to have a small percentage in this in, a satellite position, maybe less than 5% of your overall portfolio, hey, go to town. That's fine. But overall, I wouldn't put my real money into an ETF like this because I don't like the expense ratio. The fund methodology, it's an actively managed fund. For the next category, dividend growth ETFs, I like DGRO. I like the low expense ratio of DGRO. I do like the fund methodology of this ETF. I do like the holdings in the sector breakdown. It's not overly concentrated in just technology or one single sector. I do like the dividend growth rate of this ETF. It has really strong dividend growth rate. It does have a good starting dividend yield compared to the S&P 500, right? With the S&P 500, you're getting like 1.5%. So I do like the starting dividend yield with DJRO. I like the number of holdings in DJRO. I like that the top 10 only represents 26.5%. So overall, this is a really great ETF, one that I would consider a core position in your dividend growth portfolio. An example of a dividend growth ETF that I would not invest in is one, for example, this here with the ticker NDVG, the Navivan Dividend Growth ETF. It has a very high expense ratio. It has one thing that I'm not a big fan of is it does include real estate, so it's not going to be 100% qualified. Now, 5% is not going to make it or break it, but it's just one more thing that, it's not 100% qualified. So I just, what's the point? When you have so many other options out there like SHD, DJRO, VIG, I just don't see the point, for example, in investing into an ETF like this. And so you would want to make sure that you would look at the fund methodology and understand what are the rules of this ETF, but just on the surface, right? With the high expense ratio, this is one that I would just right off the bat, not even consider. And when looking at the next category, high dividend ETFs, I do like VYM. I like the low expense ratio at VYM. I do like the holding, sector allocation of VYM. I do like the top 10 holdings of VYM. I like that the top 10 do not represent more than 24%. I like that it has over 500 companies. I do like that there's more market participation, that you have a lot of companies in here, that there's not a lot of over concentration. One that I do not like is from Global X, the DIV. The expense ratio is very high. You can look at the holdings breakup. You can see that real estate is the highest sector in this ETF, so it's not going to be 100% qualified. And one thing that you really want to be mindful of with these high dividend ETFs is understanding the sector breakup. A lot of these high dividend ETFs will throw in real estate, which will make it less tax efficient. And then lastly, the ultra high dividend covered call ETFs. One that I like is JEPQ. I do like the low expense ratio. And what did I mention earlier? With the expense ratio, it's important to ask this question. Is this expense ratio justified? And for an actively managed ETF like this, I do believe that it is justified. Yes, it's higher than SEHD, but you're getting a lot more. You're getting a monthly distribution and you're getting the premiums from the options from this ETF. So you're getting a lot more than just what you get with SEHD as an example. Another thing that I like about JEPQ is the fund strategy as a whole. I like that it focuses on an out-of-the-money strategy where there's still upside potential when it comes to this. This is something that is incredibly important when you're looking at options and cover calls. Having an out-of-the-money strategy for the potential of growth is really, really important. One that I do not like as much is QLD from Global X. It has a higher expense ratio. It is not on the higher end. There are others with a much higher expense ratio, but it's still more than I would like to pay. Well, the main thing that I don't like about QLD is it has the fund methodology itself. I do not like that they sell at the money call options because it limits your upside potential. And that is the opposite of what you're getting with JEPQ because you have upside potential. Now I understand that there's a lot of information that we talked about in this video. You're not going to have all the answers from day one. It's important to understand that when you're thinking about this question, is this ETF good or bad? Is this ETF something that I want to invest in, or is it something that I want to avoid? These 7 criteria will help you analyze and decide for yourself if this ETF is good or bad for you. And just understand and remember that there's different categories, there's different buckets of ETFs, and just understand that it all stems back to what is your goal, what is your time horizon, why are you investing in this ETF? A lot of you know that I use Seeking Alpha. I use it in all of my videos. If you want to sign up to Seeking Alpha Premium, you can use my link in the description below. They do have a Labor Day special going on where you're going to get Seeking Alpha Premium and 2 free alpha picks. And this special is going on until September 3rd. If you watch this video after September 3rd, you'll get Seeking Alpha Premium at a discount, but you just won't get the 2 free alpha picks. So the first thing that I get value from with Seeking Alpha Premium is you get access to all of the articles. I follow contributors like Brad Thomas. Whenever I want to learn about REITs, Brad Thomas is usually the guy that I go to, and I'll read his articles when it comes to investing into real estate investment trusts. Another premium feature that I use on a regular basis is the dividend grades. And most importantly, I look at the dividend safety grades. Another thing that I use is the portfolio. So you can upload your portfolio. Let me pull this up here. So I can upload my portfolio and it will have the grade of every single one of my holdings. And anything and everything that I want to take a look at when it comes to the dividend metrics, the dividend growth, the dividend payout ratio, the 4-year average dividend yield. And the feature that I probably use the most is the charting feature with Seeking Alpha. Is what I really like to do is I like to understand, when I'm back testing for, different ETFs, different stocks, generally what I'm going to do is I'm going to list, okay, let's take a look at SHD, let's take a look at DGRO, let's take a look at DIV. For example, if somebody says, hey, Jake, what do you think about DIV? Well, I'm going to look at their past performance as well. I'm going to benchmark it to the S&P 500. You can only, track multiple stocks or ETFs if you have Seeking Alpha Premium. And something that I really enjoy doing is back testing for the total return. With the price return, that's just, what you see on, Google Finance, right? The total return is with the dividend reinvested, okay? And so you can see the total performance over the last year for these ETFs. You can see here that the S&P 500 has outperformed. Over the last 5 years, you can see that there's a clear difference between, winners and losers. And then lastly here, this is not unique to Premium, but this is something that I use on a regular basis, is the Seeking Alpha mobile app. I use this all the time, right? And I'm not going to disclose when I use it, where I'm sitting when I use this. But this is generally what I'm doing when I'm sitting doing things. And so you have all of the functionality that you would have on the desktop version on the mobile app. And so it's something that I use on a regular basis. I wouldn't bring it up if I didn't actually use it. But yeah, thank you so much everybody for watching the video. I hope you got value out of today's video, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.